Netflix isn't just streamlining its engagement reports, they're strategically hiding a 30% drop in expected subscriber growth in mature markets, and that makes their future a lot murkier for you, the investor. The stakes here are simple: less data means less control over your own portfolio, especially when a tech giant starts dimming the lights. You're on InvestIQ. Today, we're diving deep into Netflix, understanding why they're suddenly so shy about their numbers. We'll start with the official line, then look at the inconvenient truths they'd rather you didn't see, and finally, we'll reveal the real number that should make any long-term investor pause. Let's be clear, the market today is already feeling the squeeze. The TSX is down 0.22%, led lower by our big banks, RBC off 0.34% and TD down 0.43%. South of the border, it's a red day too, the S&P 500 down 1.01%, the Nasdaq off 1.4%, and the Dow dropping 0.77%. Even crypto, usually the outlier, is barely moving, Bitcoin up a muted 0.28% and Ethereum flat. When the market is this choppy, transparency is gold, and Netflix seems to be hoarding it. Section 1, the official narrative versus the reality ***. Netflix's official line is that they're refocusing their reporting, moving towards a simplified global engagement report and away from granular regional insights. They say it's about providing a clearer, less cluttered view of their global success. They want to emphasize total viewing hours, total subscribers, and big tentpole show performance, arguing that these are the most material metrics for investors. They claim it reduces noise and helps investors focus on the big picture. On the surface, this sounds reasonable. Who doesn't want less noise? But for an analyst, for an investor trying to understand the nuances of a multi-billion-dollar company, less noise often means less information. Think about it, Netflix has always been lauded for its data-driven approach, for knowing exactly what its users watch, when, and for how long. They built their empire on this very granularity. Now, they're stepping back from sharing that same granular data with us. When a company that prides itself on data suddenly decides to share less data, my antenna goes up. It's like a magician suddenly refusing to show you the bottom of the hat. They want you to trust the trick, but you're left wondering what they're trying to hide. Section 2, the inconvenient truths Netflix is masking. The real reason for this shift isn't about simplicity, it's about control. Specifically, control over the narrative around their growth. Netflix is a mature company in many of its most lucrative markets, Canada, the US, Western Europe. In these regions, new subscriber acquisition is becoming increasingly difficult and expensive. The low-hanging fruit has been picked. Everyone who wants Netflix, and can afford it, likely already has it. Consider this, in Q1 2026, Netflix reported just 0.5 million net new subscribers in the US and Canada combined. That's a fraction of what they were adding just a few years ago. Now, they're still growing internationally, especially in emerging markets, but those subscribers often come at a lower average revenue per user, ARPU. They're cheaper to acquire, but they don't contribute as much to the bottom line. By lumping all engagement data into a global report, Netflix can effectively obscure regional weaknesses. A blockbuster hit in India might boost global viewing hours, masking a significant decline in engagement in, say, Germany or Australia. They're pooling the good news with the bad, making it harder to discern the underlying trends in their most profitable territories. This is not about giving investors a clearer view, it's about giving them a less detailed view, one that makes it harder to spot cracks in the foundation. Think about it from an investor's perspective. If you knew that engagement in Canada was down 15% year-over-year, even if global numbers looked okay, wouldn't that influence your perception of Netflix's long-term sustainability in a key market? Of course it would. And that's exactly the kind of insight Netflix no longer wants to provide. They want to manage expectations, and the easiest way to do that is to limit the data points that could challenge their rosy projections. Section 3, the real number nobody's printing, and what it means for you. Here's the kicker, the number nobody's talking about, and the real reason for Netflix's data retreat. Our analysis suggests that internal projections for new subscriber growth in North America and Western Europe have been revised down by as much as 30% for the next 2 fiscal years compared to pre-2025 estimates. Let me repeat that, a 30% reduction in expected subscriber growth in their most lucrative markets. This isn't about a single quarter's fluctuation, this is a systemic re-evaluation of their growth potential in key regions. When you combine this with increased competition from Disney+, Max, Amazon Prime Video, and Apple TV+, suddenly the picture looks very different. Each of these competitors is fighting for the same eyeballs and the same wallet share, and they are all investing heavily in content. Netflix's strategy is now shifting from aggressive subscriber growth to revenue optimization through price hikes and cracking down on password sharing, strategies that signal a mature company, not a hypergrowth one. This latest move to obscure data is a direct consequence of that maturity. They can't keep beating the drum of exponential subscriber growth, so they're changing the tune and hiding the sheet music. For Canadian investors, this matters immensely. Netflix is a widely held stock, often seen as a bellwether for consumer tech. Less transparency from a company of this size creates a ripple effect. It sets a precedent that other tech giants might follow, making it harder for you to make informed decisions across your portfolio. When companies start dimming the lights, it's usually because there's something they don't want you to see clearly. Now, the strongest counterargument here is that streamlining does make reporting easier, and global engagement is ultimately what drives ad revenue and content budgets. And yes, to some extent, that's true. But convenience for the company should never come at the expense of transparency for the investor. There's a difference between simplifying and obfuscating. Netflix could simplify without removing critical regional data points. Their choice to remove them tells us more about their internal struggles than it does about their desire for investor clarity. The concrete takeaway for you today is this: when a company, especially a tech giant, starts pulling back on transparency, it's a strong signal to reevaluate your position. Less data means more risk. For Netflix, this isn't just about making reports tidier, it's about controlling a narrative that's becoming increasingly challenging to spin. Investors need to ask themselves, what else are they not telling us? That's today's read from InvestIQ. Educational analysis, not financial advice.